Alright everyone, I want to go over the 6th video for the Mastro Futures Trading Blueprint. What I want to go over is key trading concepts like fair value gaps and imbalances. The reason why I want to go over this is because, again, these videos aren't going to give you guys the magic potion and make you guys become profitable. This is just stuff that I wish I had when I was first starting out on trading and what to look for. Again, I trade ICT concepts. That's what's worked best for me. I was talking to somebody in the gym the other day, explaining to them that that's what I trade. He traded trend lines. That's perfectly fine. There's different ways of trading. If you guys are watching these videos, I would definitely recommend backtesting these strategies that I'm giving you, or these confluences. Like at the end of this, you'll see all these things I'm teaching you guys right now. If you guys put all the puzzle pieces together and go back and backtest it and put in the time and study this, I truly believe you guys could figure it out and learn how to read the charts and become consistently profitable over time. I don't think it's going to happen within the first year of doing this stuff, the first couple months. I was texting someone the other day also, and they're trying to learn how to get into trading, and they didn't notice how much information you gotta absorb to become a trader and to become profitable. Especially, they think you could just jump into this game and start making money, and they didn't know how much information is involved in this stuff. But by these videos, I'm just giving you guys tools to build a strategy and help put stuff together. And towards the end of this blueprint, I'm going to be teaching you guys how to put these confluences together to build a strategy. But it's going to be up to you to go back and learn this stuff on your own and put in the time and the effort to study this stuff. Like on FX Replay, go back and backtest for hours and hours and learn how to use this stuff together until it starts to go into your edge. Like I think I tested a month last night. I'm starting from doing 2024. I'm going to try and do the whole year. I did the first month of January, and I think at the end of the month I was like 68% profitable. If anybody says you're going to be 100% profitable doing this stuff, that is not true at all. I have like a 68 to 72% win rate. I'm not right all the time. Today I took a loss on the trade. I thought that the market was going to go down. I was totally wrong. It ended up going up, and I lost my trade. But that's why we have risk management. I'm going to go over risk management in the future. But today I just want to go over these continuation confluences. This is a good one to use off liquidity sweeps with break of structure. You'll use with it, but I just want to get this out of the way so you guys can learn what a fair value gap is, how to identify it on a chart. I've made previous videos on this, but I'm just going to do this for the blueprint. If you guys want to go back and watch that video, if this one doesn't make sense, I recommend going to do that. But I just want to try and explain what fair value gaps are, how to identify them the best ways possible, and then what you guys need to go do. You need to go back in your chart, go back and identify this stuff, and just make it clear in your brain. So when you guys see this in the live charts, it automatically clicks and you know what it is, and you look for a reaction off of these levels, which I'll explain, and then we'll go from there. So key trading concepts, fair value gaps, and imbalances. Let's go over the first slide. This will click. All right. Remember, if you guys have your notes out, definitely write this stuff down in your notes. You should have a journal. You should have a notebook. You should have a study book. It just helps keep you in check instead of just listening to something to let it go in one ear and out the other. But let's go. A fair value gap is a price inefficiency or an imbalance that occurs when there is a 3-candle pattern where the middle candle moves aggressively in one direction, leaving a noticeable gap between the wicks of the first and third candles. This candle represents an area where price moved too quickly, skipping a potential orders, which creates inefficiency in the market. Fair value gaps are often seen during periods of high volatility and strong momentum, typically driven by institutional traders, smart money, or significant news events. These gaps act as areas of interest for traders because price frequently retraces to fill the imbalance before continuing in its intended direction. Identifying fair value gaps can help traders pinpoint key entry and exit points, as price tends to react to these inefficiencies by either reversing or resuming its trend. Understanding how fair value gaps interact with market structure, liquidity zones, and order flow can significantly enhance a trader's ability to anticipate price movement and make informed decisions. So before we get into this, you guys got to remember, this does not work 100% of the time. You're going to notice there's going to be fair value gaps all over when you guys are looking to identify these, which is good. I want you to go back and identify them first, but you're going to look that every fair value gap doesn't work. That's why we want to add liquidity sweeps, how price is moving in what direction on a higher time frame, market structure, order flow, all that stuff. You want to put it all together, break a structure when you go down to a smaller time frame. And then I use fair value gaps on the 1 minute time frame for continuation confluences with equilibrium, which I'll explain in the future. But you can also use these high time frame imbalances like a 1 hour fair value gap or a 4 hour fair value gap or imbalance for take profit levels or reversal areas. It's just, once you learn how to start using these, you'll start to see how the market moves to react off them or continue the trend in the direction that it's intended to go into. So, how to use fair value gaps and imbalances. When looking for trade entries, using fair value gaps is essential to identify a strong trend, whether bullish or bearish, and wait for price to retest the imbalance before continuing in its intended direction. In an uptrend, price may pull back to fill a bullish fair value gap, providing traders with a potential buying opportunity before resuming higher. Conversely, in a downtrend, price may retrace into a bearish fair value gap before continuing lower, creating an ideal setup for short positions. However, relying solely on fair value gaps is not enough. Like I just explained, confluence is key to increasing the probability of success. Traders should combine fair value gaps with other market structure elements such as support and resistance levels, liquidity zones, order blocks, equilibrium levels, and trend confirmation tools like moving averages or higher time frame analysis. Additionally, observing volume and momentum shifts when price interacts with the fair value gap can further validate trade entries. By integrating multiple factors into their strategy, traders can improve their precision and avoid false signals, ensuring that their trades align with the overall market flow. So, if you don't really understand what I just said there, when you guys use fair value gaps, let's use a liquidity sweep for an example, what we went over the last video. Let's say we have a 4-hour liquidity sweep, a 4-hour high, gets swept, we break structure to the downside on the 5-minute time frame, we get our retracement, we scale down into the 1-minute time frame, we'd look for our continuation confluence for confirmation, we'd look for a 1-minute fair value gap, and let's say price comes into the fair value gap to go to the downside, we fill it, and then we get selling pressure out of it to the downside. That would be our entry point because number one, we had a high time frame liquidity sweep. Boom, that's one confirmation right there. Number two, we had a break of structure on the 5-minute. Boom, that's 3 confirmation right there. Number 3, we're coming down. Number 3, I think I said number 2. I'm a little retarded. You gotta be a little patient with me. But number 3, you scale down to the 1-minute time frame. Price fills your fair value gap, shows selling pressure out of it. That's another confirmation for an entry. Boom, that's three confirmations right there. And in your favor, the probability of your trade working to the downside is pretty high. It might not work. That's just trading for you. But the probability of your trade playing out is pretty high because you have three confirmations that the price is going to continue in your direction. You can add more with that too. So let's say if you had your equilibrium level, that's what I use, with your fair value gap to the downside. So price fills equilibrium and also fills the fair value gap on the 1-minute time frame and shows selling pressure out of both. Boom, that's 4 confirmations right there. So that makes your entry even more, the probability more for the price to continue in that intended direction. So how to identify a bullish fair value gap or imbalance? A bullish fair value gap forms when price moves aggressively upward, creating an imbalance in the market due to strong buying pressure. This typically occurs when institutional traders or smart money execute large orders, causing price to rally rapidly. So as we can see in these examples, guys, and I'll go over on the charts at the end real quick, but I wanted to draw these out for you. So as we can see, we have 3 candlesticks right here, right? 3 bullish candles. It doesn't matter if there's a bearish candle either on this example down here. We have 3 candles up with a gap in between the 3 of them, right? Where you're going to look for your fair value gap is from the first candle's wick, the high wick, to the third candle's bottom wick right here. And you'll mark out the box like I did between the middle. So this is an area where people could fill more orders and continue price in the upward direction. So same example here, but this is a bearish candle. It doesn't matter. We have 3 candles up. There's a gap in between. We're in a bullish trend. We want price to come down into this fair value gap. And as you can see in this example, we'd like to get a candle like this out of it, a bullish candle. If we see buying pressure out of it, even when you get a bearish candle into it, but it didn't invalidate it, it's still above it, it wicked below, but it still stayed inside the imbalance, then you can see people filled their buying orders. pushed price up, we got buying pressure out of it. This would be our entry for the example right here. And then we target our 4-hour high or 1-hour high or 5-minute, whatever our liquidity is above. And then we put our stop below where the fair value gap was created on the first candle, on the bottom wick. Just to be safe, just in case price comes back down, retraces back in here, wicks down a little bit, and then continues higher. So it's really that simple. All you have to do is look for a 3 candlestick pattern, as we're looking at the bullish trend right now, right? 3 candlestick pattern. If there's a gap in between where the middle candle as it makes a big move up, we mark it from the top of the first wick on the first candle to the bottom of the third wick right here on the third candle, and then we mark our box right in between both of these where the middle candle is, and this area right here from the top of the first candle, the wick, to the bottom wick of the third candle. This is our imbalanced price range right here, where people, if price comes back down, they want to get a better entry, they fill their buy orders at a cheaper price, and then they continue price up in the intended direction. So if you guys want to write this down in your notes right here, instead of just listening to me explain that, I put this in here so you guys can learn how to identify it. Steps to identify your bullish fair value gap. Number 1, find a strong upward move, right? You look for your bullish 3 candle pattern where the middle candle has a large body indicating strong momentum to the upside. This move should break through a key level, resistance or liquidity zone. That's like if we get a liquidity sweep, right? Identify the gap between the wicks. The first candle's high and the third candle's low should have the visible gap between them. This gap represents the fair value gap in an area where price moved too quickly, skipping potential orders. Now we watch for price to revisit the fair value gap like we said. Price often retraces into the gap before continuing higher. A bullish reaction confirms buyers are stepping in. So we look for our confluence, combine fair value gaps with key support levels, liquidity pools, trend lines, order blocks, strengthen the trade, whatever you guys are going to use. I use mine with, like I said, a liquidity sweep, a break of structure, and then I scale down to the lower time frames, and I use these as a continuation confluence for confirmation to go up in the intended direction. So like I said, like higher time frames, if you have a 1 hour, a 4 hour, or a daily chart, this adds confirmation if you guys sweep that area of your liquidity, and then you confirm your entry, and then make sure you have your risk management, which we will go over in the future videos on this blueprint. But let's go over how to identify a bearish fair value gap. It's literally the same exact thing, just the opposite, guys. A bearish fair value gap forms when price drops aggressively, creating an imbalance in the market due to a strong selling pressure. This typically occurs when institutional traders of smart money execute large sell orders, causing price to fall rapidly with minimal resistance. So, same exact thing, guys, just in a downtrend. Oh, sorry. Let's go back. Messing this up. Sorry. All right, as we can see, we have 3 downward candles, right? And again, it doesn't matter if this one's green, as long as the middle one is red, and if we're bearish, and then the middle one is green if we're bullish. It matters what your chart setup looks like. Whatever color is bullish for you and whatever color is bearish. But if we're in a downtrend, for me, it's a red candle. We want that middle candle to be red. If we're in an uptrend, I want that middle candle to be green. So back to this example, we have 3 continuous candles down to the downside, right? We mark on this one now from the first candle, the highest candle, from the bottom wick of that one to the third candle wick's high. And then we mark our box in between. And then this area right here, if price comes back into it and shows selling pressure out of it, that shows that people filled more sell orders here to get a cheaper price, and then they pushed price in the intended direction. So as you can see, same example here. We mark it from the first candle's bottom wick to the third candle's top wick, draw our box between there, and this is our price where the fair value gap will be, where we want people to come in, fill in more sell orders, and we see that. Price continues to the downside, we enter off the trade, put our stops above where the fair value gap was created, and then we target our sell side liquidity. So here's a perfect example. 3 candlestick pattern, right? Middle candle has a big drop in the middle. We mark from our first candle's bottom wick to our third candle's top wick. Mark that out. There's our box. Then we'd wait for price to come back up. We came up here, wicked above it. We didn't close above. If price closed above here, then it would be a invalidating the fair value gap, then we would have to reassess what we're doing and look for a better entry. But came back up in here, wicked above, ended up closing very bearish, right? A lot of sell orders look like they got filled here. We enter at the candle close. Remember, always enter at the candle close. Don't just enter because you see the candle going the other way. Before it closes, it could totally reverse and go in a different direction. The candle closes. This would be our entry right here. We put our stops above where the fair value gap was created on the third candle, above that the high wick of that one, the first one, and then we target our sell side liquidity down below. It's really that simple. Once you guys learn how to do this stuff and how to identify it and react off these, you're going to understand why I keep saying it's that simple. At first, this stuff was difficult for me to learn, but once you guys see it in real time and you go back and back test this and just go back in your charts and identify what a fair value gap is, then you'll learn how to use them with confluences with the other ones I'm going to teach you. So if you guys want to write down your notes again, I put the step-by-step here. If you guys want to write this down for how to identify a bearish fair value gap, we have find a strong downtrend move, identify the gap between the wicks, watch for price to revisit the fair value gap, look for your confluence, confirm your entry and your risk management, and boom, you go from there, you enter your trade, and then we'll see if it plays out. But here's my stay connected for social media stuff, guys. Hopefully this video makes a lot of sense for you. I'm going to go over in the live chart real quick what you guys should do. But again, there's my Instagram. You guys have my YouTube. Like and subscribe to these videos. I appreciate you guys doing that stuff for me. But let's go into the live chart here. Sorry, this is what I was drawing it out. So what you guys should do, you guys can go into your TradingView account or your FX replay. And what you guys are going to do, this is how I learned. I just go on, let's go on the 4-hour time frame, for example, right? And let's say you don't even know what a fair value gap is. You don't know how to use it. You don't know how to identify it. First step you should do is just go on your TradingView or your FX replay and just look for what a fair value gap is. So we see right here, 3 candle continuation confluence to the downside, right? So we have 1, 2, 3. For a bearish, this is in a bearish trend, we mark the first candle, right? The bottom wick of the first candle to the top wick of the third candle. There's a fair value gap. That's all you got to do until you just learn how to identify them first, and then in the future we'll go off the continuation confluences and start putting the pieces together. But if you don't know what a fair value gap is and you don't know how to identify it, this is a great way to do it. Do this for 30 minutes a night, and I bet you in a month you'll be seeing these just like it'd be like butter. You'll be able to just identify them when the price is moving there, and you'll be able to see a fair value gap easily. But there you go. We have a bearish fair value gap. Boom, nice and simple. Let's see if we find another one. All right, 3 candles to the downside. There's a gap in between this one, and there's a gap in between this one. Look, first fair value gap. We go to the bottom wick of the first candle to the top wick of the third candle. Boom, we have a fair value gap there. And we have another one underneath it. This is now the new first candle. So we go to the bottom wick of the first candle to the top wick of the third candle, and this is an upward candle too. Like I said, the middle candle just has to be red since we're in the downtrend. And boom, there's another one. As you can see, price came back in. We got selling pressure out of it. This could have been an entry right here, let's say, for an example. Stop above the first candle's high, and then you target your sell side liquidity down below. And that could have been a 1 to 3.7. That's on the 4-hour time frame. You don't want to just take blindly fair value gap trades off the 4-hour time frame. You want to scale down and get a good entry. But this is just for an example right now for fair value gaps. All right, let's go. Let's find a bullish fair value gap. All right, look right here. Both of the first and the third candle are both red, but this is still a bullish fair value gap because the middle candle is black in my case. That means up, so it'd be green, whatever color you guys have. But right here, we'd mark it from the first candle's high, the wick, to the third candle wick right here. Boom. I'll make this black for you. There's a bullish fair value gap. But as you can see, this got disrespected. This turns into an inverse fair value gap. And I'll explain that in the future, but then price came back up to it, continued pricing the downside. Let's not confuse you yet. We'll go over inverse fair value gaps. I made a video previously about it if you want to go watch that after this, but I'll make another one in the trading recap. But this works on every time frame, guys. Let's go to the 1-hour time frame. Do the same thing. I'll go all the way back here on a different time. Sorry, the dogs are barking. But as you can see, for the last example we'll have here, We have a big drop to the downside. There's multiple right here. Every time you see one. So we have a from the top wick, from the first candle's bottom wick to the third candle's top wick. There's a bearish imbalance right there, a fair value gap. Same thing. We have another one below. 1, 2, 3. Gap in between the middle candle, right? First candle, bottom wick, to the third candle, top wick. Boom, there's another fair value gap. Didn't get any reaction off of it, right? Same thing here. You got the first candle's bottom wick to the third candle's top wick. Boom, there's another fair value gap. No reaction off of it. Look, we form another one. First candle's bottom wick to the third candle's top wick. There we go. We have another fair value gap. Price comes in, consolidates a little bit. Boom, sells out of it, continues in its intended direction. So let's do one more example for you guys of a bullish one. And then this should be pretty good. But this is what you guys should be doing. You go through your charts on every time frame and just look to identify what a fair value gap is. Here's another perfect example. So we're in a bullish trend, right? Big candle up. Go from the first candle's top wick. Remember, it's opposite when we're doing a bullish trend. So we have the first candle's top wick to the third candle's bottom wick. Turn this black real quick because this is my color for bullish. And as you can see, we wait for price to come back down. Came back down, tapped into it here. We didn't get buying pressure out of it, a buying pressure candle out of it, but we would have scaled down to a smaller time frame, and there most likely would have been an entry for you to take, and then price continues up in its intended direction. So, and as you can see, price even came back into it later, reacted off of it, and continued up again and again. And see, it shows you how fair value gaps can actually work. You just have to learn how to use them with confluences to identify your entry and get a good entry on your trade. So, again, you don't just go into the markets just seeing a fair value gap and taking a trade because price reacts off of it. I'm going to teach you guys continuation confluences off of this, and you want to use multiple continuation confluences off the strategy you build over time. So hopefully you guys can understand a fair value gap or an imbalance more after this video. You guys have my Instagram. If you guys have any questions, you can send me a DM. You guys have my YouTube. Make sure you just like and subscribe, and we'll keep getting these videos out there. But I just wanted to get this 6th video out for the Mastro Futures Trading Blueprint. I think I have 4 more to post, but I'm trying to just put 10 videos that the most useful information that you guys can have to start putting together a strategy to help you become profitable in the future. This stuff isn't just going to make you profitable right away. There's no secret cheat code or anything when it comes to trading. You guys have to put the time, the effort, the back testing, the studying, everything into this stuff, and it'll happen over years, months, however long it takes you. Everybody's different, but again, I've been trading for 6 years. This stuff took me 6 years to learn. I still have a lot more to go, and it's just part of the game. But hopefully you guys enjoyed this video. I'll get this posted up as quick as possible, and then we'll get the other ones up for the rest of the week. Appreciate it.